a new record high. Was trading above 37,000 for the first time ever. Stocks are higher and sharply so across the board. Yields, they're going in the opposite direction. They are falling, and they are falling sharply. Look at the 10-year note yield, 4.04. Just an extraordinary a bit of events there in Washington. The Fed chair saying they're proceeding carefully. They're seeing what they've wanted to see in terms of inflation coming down. He mentioned their own estimates of PCE continuing to move closer towards target. Stocks up a little more on that. He said the Fed is, quote, likely at or near the peak rate for this cycle. Stocks up a little more on that. Bob Pisani calling what happened today about as Goldilocks as it gets. Our own Steve Leishman, who's going to join us momentarily, suggesting, quote, the Fed took a step towards the market rather than the other way around. Joining me now is DoubleLine Capital's Jeffrey Gundlach. He's with us exclusively, as he always is once the Fed chair finishes. Jeffrey, welcome back for our final visit of the year. I'm glad you're with us today.
Yeah, we made it all the way to December, Judge. Interesting times.
Yeah, that's for certain. I mentioned what Pisani and Leishman have called it. What would you call today?
Well, it's pretty dovish. I mean, the word of the day is any. Last meeting, the word was careful. He said that multiple times last meeting. Market likes that because it respected the fact that the curve's inverted and economy's slowing down. But that any word didn't have to be inserted. And it strongly suggests that the Fed inserted that because they believe, I think, that they're done. And not only are they done, what a lot of people don't realize is the Fed has been on hold for 4 of the last 5 meetings. So it's a trend. And we talked last meeting, November 1st, that we had started a bond rally that day. And what a rally it's turned into. It's turned into quite a good 6 weeks with the 10-year Treasury yield down 100 basis points and the long bond, up in the double digits. So we had a November to remember, one of my clients said in a meeting I did with him yesterday, with one of the best months ever for the investment-grade bond market, up over 4.5% in the month of November alone. That hasn't happened since the 80s, which is really something because last time it happened, you were starting with yields up at 10%-ish, and here you were starting with yields at 5-ish, so half the yield. So you needed an even bigger basis point move in rates. So I thought the most interesting thing of the press conference came near the end, where if I heard it right, I think Jay Powell said that he wants to cut rates before we get to 2, if I heard him right. And because he's respecting the momentum that inflation can have. Just like I criticized him 2 years ago for going too slowly, and inflation overshot by 500 basis points above where they thought it was going to 4% or so. It peaked out on the CPI at 9, and now it's coming down just as fast. And I heard a lot of people before the announcement were talking about, you can take 3-month PCE, you can look at core this and that, 1-month data and everything. There's ways to get to 2% sort of numbers. And I'll just add one that I didn't hear today. That's core CPI ex shelter, which is at 2%. And the reason I bring that up is shelter is a bad construct. It's owner's equivalent rent, and it lags. And it appears to our research that owner's equivalent rent is going to come down by at least 400 basis points over the course of 2024. And since that's about 30% of CPI, kind of there you go. So our CPI model suggests that we're only going to get 1 more month of a 3-handle CPI year over year, and that it's quite possible at this point that the headline CPI could be 2.4 in June. And if that's the case, I think the Fed cuts rates, because I heard Jay Powell, I think, say that, we can't wait until inflation's at 2, because he respects the momentum on the downside, because he learned a little bit of a lesson about the momentum on the upside.